Let's bring in Michael Kantrowitz. He's Chief Investment Strategist with Piper Sandler. Welcome to you. I was joking with Craig Johnson the other day because your technical analyst has been so bullish. You've been much more cautious, and this has been one of the weirdest cycles I think we've all ever lived through.
Yeah, absolutely. Craig's had a great call, sticking with it throughout the year with all the concerns and pullbacks. We're more aligned this year.
Really? Is he more cautious about 2024?
He sees limited upside for equities, some rotation out of some of the larger cap names. I think where we differ a little bit is in how much breadth we can get out of the market. And our view here is that don't confuse a bond yield rally, which really propelled the stock market back 2 months of the year,
right,
with an earnings recovery rally.
Right, exactly. So we saw, in other words, bond yields, which went to their lows below 3.8% in late December, and we're showing this chart here. That's really when we saw a lot of the stocks, a lot of the momentum names and that kind of thing break out to their highs. It's interesting to me how much just the 10-year going back above 4% seems to have changed the narrative. And do you think that's the culprit here?
Yeah, well, I think we came into the end of the year and people really focused just on how we're going to end the year. And then we started the beginning of the year and people said, okay, I got a lot of growth stocks because those have all done so well for so many years and certainly last year. All of these cyclical, risky, high beta value names and small caps went from 52-week lows, many of them to 52-week highs.
Right.
And I got no defense. And we've priced in perfection, a soft landing, rate cuts, tight credit spreads, low volatility, and pretty much a new high in the S&P. So I think the reality is that we got a little ahead of our skis in terms of how much the Fed will cut this year, at least given the data we have today, and we got to digest that.
It sure does feel as though the market was pricing in a more rapid and maybe more precipitous decline in interest rates than is now likely. Do you see today's CPI number as indicating that inflation is plateauing at a higher level? Is this a pause in a decline, a plateauing that will require the Fed to stay tighter for longer, or what?
I think
or neither, because it's really, we're talking about tenths of a percentage point here, and that's margin of error stuff to me.
I think the most important thing for inflation is that oil prices are really low, gasoline prices are really low, and for the consumer, I think that's having a benefit. The economy is still okay. Employment is still okay. The data are softening, but not enough to really have a big impact on wages and companies' pricing ability. It is declining, but I think we've seen the low-hanging fruit from
the increase in prices is declining, but prices themselves are not. I ordered last night from a not very fancy Italian restaurant in my town a chicken parm, a pizza, and a pasta alla vodka. And it was $70.
What did everyone else have?
Yeah, it was. I'm going, wow, that's a lot of money. Yeah. But with tip, it was 85, and sure.
And that gets back to employment. Prices aren't going to really fall on a lot of the services, and that's where CPI remains sticky in this report. Until you see jobs really decline, and companies can either hoard labor or and suffer on margins and keep prices high, or they're going to have to cut their prices to maintain market share.